Hi class. Today we're going to look at problem 11-2b, which is very similar to problem 11-2a that is assigned on your homework. So this chapter covers the statement of cash flows, and to me that is the hardest financial statement to complete. We're going to do those at a fairly basic level in this particular class, so the templates do help us a little bit because they are giving us the basic format of the things to look for. So I've created a template for this piece of for this example that's very similar to the template in your homework. So if you want to follow along, I'm on page 550 of the textbook. It says P11-2b, Natalie King has completed the basic format to be used in preparing the statement of cash flows using the indirect method for CPU hardware designers. All amounts are in thousands. And then we are given a basic template, and it says below in random order are line items to be included in the statement of cash flows, and we're given a list of items, and we are to prepare the statement of cash flows using the indirect method. So to do the indirect method for the statement of cash flows, we are going to start with the net income, and that amount is given in the list of items. So it says net income is $80,000. So I'm going to plug that in there. And then I want to remind you that there's three sections to a statement of cash flows. The top section is the cash flows from operating activities. Then we have cash flows from investing activities. And finally, cash flows from financing activities. Then down at the bottom, we have a little bit of a reconciliation of our cash at the beginning of the period to the cash at the end of the period. So we're going to start up here with our cash flows from operating activities. And in this section, we're going to use the net income as a starting point for the cash that was generated from operating activities. And we're going to adjust that net income for items that affected net income that may have affected the actual cash flows, or the difference in the cash flows is different than what the amounts were that affected net income. So let's look at some examples to be specific about that. So the first one we have on our list in our template is depreciation expense. So if we look at the instructions for the problem, it says we had $30,000 of depreciation expense for our company. Now when we think about how we arrived at that net income amount of $80,000, we had some revenue and we subtracted out some expenses to get our net income. And one of those expenses that we subtracted out to arrive at net income was depreciation expense. But depreciation expense is not a cash expense. It is an adjustment that we're making on our books. It doesn't involve the exchange of cash as far as recording the depreciation. So we are going to have to adjust that net income because we took out depreciation expense from our revenue, and that was not a cash flow expense. So when we took it out, to start with, we took it out on our income statement. We subtracted depreciation expense because it's an expense. So here we're going to add it back because that was an expense that did not involve the flow of cash. So depreciation expense we're going to add back in. The next item says there was a loss on the sale of land, and this problem, it makes it fairly easy because it tells us the amount. It says loss on sale of land was $8,000. All right, that's another expense that we are going to add back in. And we're going to add it back in because that's a part of the loss on that sale of land. And we're actually going to record that sale of land down in the next section. So up here, we're going to add back that loss to our net income. All right, then the next thing, it says increase in accounts receivable. And again, in this problem, it tells us that we had a $70,000 increase in accounts receivable. So if you think about increases in accounts receivable, we have accounts receivable because we made sales, but we didn't yet collect the cash for those sales. So we recorded those sales in our revenue, but we didn't actually collect cash. So those revenue were recorded up here so when we arrived at our net income, we took our total revenue, whether we received payment for that revenue or not. But we used the total revenue and we subtracted out our expenses. So the total revenue that we used up here to get our net income was both cash and credit revenue, but part of those did not involve an exchange of cash. So the amount of the increase in accounts receivable of $70,000 means that we had $70,000 of sales, additional sales that we did not collect cash for. So we're going to subtract those out because we didn't actually get the money for those yet. So an increase in accounts receivable, we're going to subtract that out. If we had a decrease in accounts receivable, we would do the opposite. We would add back the $70,000 if there was a $70,000 decrease in accounts receivable. So some of these you may just kind of have to make sort of a list or a recipe of what you do, if this, then that. So depreciation expense, we're always going to add that back. Loss, we're always going to add that back. If we had a gain, we would subtract it. Increase in accounts receivable, we're subtracting that amount. If it was a decrease in accounts receivable, we would add that. All right, an increase in inventory, we're going to subtract out that, and that amount is given in the instructions. It says it was $40,000. So again, this may be one of those things you list out. If there's an increase in inventory, you subtract it. If there's a decrease in inventory, you add it. And the reason is, if we had an increase in inventory, we purchased some inventory that we hadn't sold yet, but that inventory, purchase of that inventory was an expense that we had, but it didn't actually involve a cash transaction because our inventory increased or decreased. So we're making that adjustment to adjust for the actual cash that did or did not change hands whenever we had changes in inventory level. Increase in prepaid rent, it says was $11,000, so we're going to subtract that out. And again, if that's an increase in prepaid rent, if it was an increase in any other prepaid expense, you would do the same thing. You would subtract it out. If it was a decrease in a prepaid expense, then you would add it back. We have an increase in prepaid rent, and remember when we recorded prepaid rent, we paid cash for an asset. And because it's prepaid rent, that is not an expense yet, it's an asset. So that cash exchange for that prepaid rent never affected net income because it wasn't an expense yet. But it did use cash. So here we're reflecting that we used cash for something that was not included in our net income because it's not an expense yet. All right, then it says increase in accounts payable is $11,000. So we're going to add that back in. Because remember, when we record accounts payable, those are amounts that we owe for expenses. So those expenses that we incurred were included in our net income calculation. However, those expenses did not involve the exchange of cash because we haven't paid cash yet. So we're adding back that amount of that expense back to our net income because we took that amount out, but that amount wasn't paid in cash yet. So if we add and subtract all of those together, so total all those up, and I put a formula in here so mine did it automatically, we get $8,000 in cash flows from operating activities. So the next section we're going to complete is cash flows from investing activities, and we've got two items that are listed, cash received from sale of land and purchase of equipment. So the cash we received from the sale of land was $4,000, and we're going to add that into our, because that was a cash inflow from an investment. And investments, if you purchase or sell equipment, or you purchase or sell land, or you purchase or sell a building, or you purchase and sell any other kind of investment, those would be reflected in this section. So there's our cash received from sale of land, and we purchased equipment, and their instructions tell us we purchased $230,000 worth of equipment. So if we purchased equipment, that involves some payment of cash. Payments of cash are outflows of cash, so we're going to subtract that out because we actually paid out cash. So we're going to total those two items up, and we have $226,000 cash flows used in investing activities. In the next section, we have cash flows from financing activities. And we have 3 items in that. We have an issuance of common stock, a payment of dividends, and a repayment of a notes payable. And so all of these amounts are given in the instructions. So we issued common stock. So if we issued common stock, someone paid us cash for that common stock. So they actually paid us $300,000. So that's a cash inflow. If we paid dividends, then we paid dividends to those stockholders. So we are paying them cash. So that's a cash outflow, and that's $50,000. And then it says we repaid notes payable. And that was $60,000, and we actually paid them cash, so that's a cash outflow, so we're going to subtract that out. And that gives us a $190,000 net cash flow from financing activity. So if we had borrowed notes payable, it would have, the opposite would have been true. Instead of a minus, instead of subtracting out that amount, we would add if we were borrowing some money or financing something that would be there. So then we have net increase or decrease in cash. So to calculate that, we're going to total the net cash flows from operating activities, the net cash flows used in investing activities, and the net cash flows from financing activities. So if we total all 3 of those, we have $28,000 of a decrease in cash. So that's a minus because it's a decrease. The cash at the beginning of the period, that's actually listed in the instructions. So we had $90,000 at the beginning of the period. And if we take the decrease in cash plus the cash at the beginning of the period, we should have the cash at the end of the period, which is $62,000. And I had mine calculating in the template, but that matches what they tell us in the problem. So we are correct in that. And that is all there is to this particular problem.